So now let's take a look at profitability ratios from a different perspective. So we already know what ROE is, ROA, profit margin. So the DuPont identity is the system, the framework that pretty much connects return on assets to profit margin to return on equity. And it's a very good way to visualize and factorize pretty much the different driving forces behind those ratios. So factorization is when you represent something as a product of two factors. So that's exactly what DuPont identity does. It basically factorizes ROE and ROA. That helps you to get a deeper insight in possible reasons or ways to improve your profitability ratios. So let me derive those ratios with you. So you have them here on the slides, but I'm going to do it step by step so that you can see the thought process. So let me start with ROA. So if you remember, by definition, return on assets is equal to net income divided by assets. So what I'm going to do, I'm going to multiply by sales and divide by sales. So of course, mathematically, it's not a problem because sales divided by sales is 1. So I can legitimately do it. So what does it give to me? Well, it allows me now to regroup those numerators and denominators in a very interesting way. So now I'm going to write it down as net income divided by sales times sales divided by assets. Okay? Now, if you remember, net income divided by sales is your profit margin. I'm going to call it PM. Well, actually, let me write it down as profit margin. And sales divided by assets is your asset turnover. So, we are getting very interesting representation of return on assets. It turns out that if you want to improve your return on assets, there are two factors that might actually help you: your profit margin and your asset turnover. So now we are ready to sort of write a prescription for a company. So let's say the firm experiencing low return on assets compared to the industry standard. Okay? We tried to figure out what the company could or should do in order to improve its return on assets. And DuPont identity in this case helps you to identify two important factors. One is you can just improve your profitability per dollar of your sales, which is profit margin. But another one, which is less obvious, is your asset turnover. So you should be able to more efficiently generate sales with your assets. So think about it this way. Suppose you have relatively low profit margin, but your asset turnover is high. What does it mean? It means that even though you're making very little per dollar of your sales, you're able to generate a lot of sales with your assets. And it turns out that in this case, maybe the product of profit margin times asset turnover is actually bigger than the industry standard. Or it could be the other way around. Maybe your asset turnover is relatively slow. Let's say you are some kind of luxury goods store, right, like Tiffany's in New York City. Your asset turnover might not be that high because people just don't buy a lot of this stuff. But your profit margin might be gigantic. So what happens is your overall return on assets is primarily driven by extremely high profit margins. Companies like Walmart, on the other hand, would be the opposite case. Their profit margins are relatively low, but they're able to generate a lot of sales with their assets. That would indicate very fast asset turnover. Either way, ideally, you would like to have high profit margin and high asset turnover, but it cannot always be the case. It depends on what's going on in the industry. So the bottom line is that this simple DuPont identity allows you to figure out the ways to improve your return on assets. So I'm going to write it down as ways to improve ROA. So number one, increase profit margin. Okay, remember, everything else equal. We always want to make sure that you don't increase your profit margin and at the same time you reduce your asset turnover, because that would defeat the purpose. The goal here is to do it everything else equal. So what can I do, everything else equal, what can I do to increase my profit margin? Well, your first reaction might be raise the price. But you gotta be careful. If you simply increase the price, you will indeed increase your profit margin, but you will automatically reduce your asset turnover because your sales will suffer. If you operate in competitive environment, if you're not an absolute monopolist, raising your price will make your product less competitive. Okay? So what's going to happen if you simply raise your price, your sales will drop and your asset turnover will slow down. And there is no guarantee that simple increase in price and as a result increase in profit margin will really increase your return on assets because your asset turnover might slow down by more compared to increase in profit margin. So when we say increase profit margin, most of the time we mean reduce your cost. So that's a much better way to improve your profit margin, and most companies try to do it that way. So if you're talking about firms trying to improve their profit margins, most of the time they are doing it by becoming more efficient, by becoming leaner, by learning how to produce product better and more efficiently, perhaps achieving certain economies of scale, perhaps negotiating better deals with suppliers, and so on and so forth, maybe improving their supply chain by locating closer to suppliers, eliminating some unnecessary distribution expenses. So the point is you want to reduce your cost. That's the way to improve your profit margin without reducing your asset turnover. Okay, so number two will be increase your asset turnover. Now, what are the ways to improve your asset turnover? Well, the best way to understand it is to remember that asset turnover is driven by turnovers of different types of assets: inventory turnover, accounts receivable turnover, and fixed asset turnover. So let's start with each of them and prescribe certain actions. So for example, if I want to improve inventory turnover, so what should I do? Improve sales forecast. Okay. And maybe more efficient inventory management or more efficient supply chain. Okay. So more efficient inventory management. Okay, so these two would result in inventory turnover going up. Okay, the next one would be your accounts receivable turnover. So what you're gonna do, you will increase or reduce, let's say, reduce credit sales. Okay, but again, you don't want to reduce your credit sales and as a result reduce all of your sales. You just want to make sure that you reduce credit sales proportion, let's say. Okay, in total sales. Also, you improve customer screening and collection policy. Okay. And collection policy. So that would result in accounts receivable, I'm going to call it AR, turnover. Okay. And finally, of course, last but not the least, you have your fixed asset turnover. So for that, you would need to improve your capacity management. So basically, we could simply say better capacity utilization. Okay, so that would result in fixed asset turnover going up. So we talked about it before. Better capacity utilization would mean that you simply investigate your capacity and see if you have some idle capacity. So what you're gonna do, you could try to load those plants and equipment with more sales, but if you cannot simply do it, then just get rid of those extra assets. You don't need them, divest them, sell them somewhere in the market. Okay, so as you can see, a very simple decomposition, factorization of ROA into profit margin and asset turnover gives us a lot of insight in the ways that the company can improve its performance. And it's a very, very common factorization. You see it everywhere. All the analysts, they do it all the time. They look at ROA and they factorize it and they see how much of it is driven by profit margin, how much is driven by asset turnover, and more importantly, they compare to the industry standards. Okay, so if you're Walmart, you're being compared to Target, and they see where Walmart is doing better or worse compared to Target, or maybe some industry average. Okay, instead of looking at just one company comparison, they look at some peer group, like average of the top 20 competitors, something like that. Okay, so that would give you your ROA. Now let's do ROE. So we have further analysis here, return on equity. So your return on equity by definition is net income over equity. So now I'm going to do the same thing. I'm going to multiply and divide, but I'm going to do it by multiplying and dividing by assets. Okay, so now I have my net income over assets times assets over equity. Okay, so net income over assets, that's your ROA. We know that already, so that's your return on assets. And assets over equity, if you remember, it was called equity multiplier. Okay, so remember we considered those debt utilization or solvency ratios. And remember I told you that assets divided by equity is also equal to 1 plus debt over equity. We derived that result, but it's also called equity multiplier. So I'm going to say ROA times equity multiplier, or alternatively, I will rewrite it as ROA times 1 plus debt over equity. Okay, so now what does this kind of factorization tell us? It tells us that if you want to further boost your ROE, of course you want to improve your ROA. Okay, so I'm going to write that down as follows. I'm going to say ways to improve ROE. So number one is increase your ROA. And that makes sense. Of course, return on equity will always rise if return on assets is rising. And now you know how to improve return on asset. You have all these factors right here, okay, that help you to improve your ROA. So that's pretty obvious. What is not obvious which is a little subtle, is that another way to improve your ROE is to increase debt relative to equity. So as you can see, automatically, when you increase your debt to equity ratio, your ROE goes up mechanically, automatically. But you have to be extremely careful here, because increase in debt to equity, everything else equal, will probably improve your ROE, but it may also give you a lot of risk. So in a moment, I'll just demonstrate that. I'll show you an example. So improving ROA is an obvious good way to improve your ROE. But increasing debt to equity or leverage, okay, may be tricky. So you gotta put something like maybe risky. So you gotta be very careful with that, okay? But companies do that. Companies do that all the time. They try to increase their leverage sometimes and boost their return on equity, or alternatively earnings per share. Okay, so let me show you how does that work. If you're not convinced, if it's not obvious to you why debt to equity ratio improves ROE, or mechanically changes ROE, let's just consider a very simple example. So suppose you have two companies. Okay, so one of them is 100% financed, another one is 50-50. And you will see the difference between their ROAs and ROEs. So let me call it firm A. And here I'm going to have firm B. Okay, so we have assets. We have debt. I'm not going to call it liability. I'm going to call it just debt. And equity. Same here. Assets, debt, equity. Okay. All right. So firm A has $100 assets, $100 debt, and $100 equity. Firm B has identical amount of assets. So size-wise, they're very similar, but it has 50-50 debt to equity ratio. Okay. So, oh, I'm sorry. I made a mistake here. Debt is equal to 0. So firm A is 100% equity financed. Now imagine that they generate exactly the same net income. I'm going to call it net NI. So I'm going to call it NIA equal to, let's say, 10. And net income of B is also equal to 10. So they are equally profitable in absolute terms. So now let's calculate ROA. So return on assets A is equal to 10 divided by 100. So that gives me 0.1 or 10%. Okay, and ROA B is exactly the same, 10 divided by 100 equal to 10%. Okay, so far they are identical, which makes sense. But here's where the debt becomes important. For firm A, ROE is still 10 divided by 100 because the equity is $100. It's the same as assets. There is no debt. As a result, it's also equal to 10%, just like ROA. However, for firm B, right, ROEB is equal to 10 divided by 50. Okay, because equity is much smaller for firm B. So what happens is suddenly ROE is 20%. So basically, what you can see is that two seemingly identical firms, in terms of their overall asset size and their overall income or net profit or net income, they have very different return on equity. Firm B has twice as large return on equity compared to firm A. And that's not surprising. It's because that allows it to divide that amount of income by smaller amount of equity. Think about it this way. If you're making a lot of money, all right, but the number of people who you want to divide among, the owners, is smaller, it means that per owner or per share of the ownership, that income is going to be much larger. You might say, wait a minute, but that requires interest payments. Absolutely, but those interest payments are relatively small. And you could always make an assumption that you got debt with 0% interest rate. So let's just imagine that we operate in very low interest rate environment so that we don't need to worry about exuberant interest payments. So let's just imagine that interest is equal to 0. So you're getting $50, 0% debt. The only thing you have to do is just to pay it back eventually, but you don't need to make any interest payments. Then of course, as a result of that, the same income that you generate compared to firm A will be distributed among fewer shares. And as a result, your return on equity or earnings per share will be much, much larger. That's an effect of leverage. And companies use it all the time. They always use leverage in order to boost their earnings and to boost their return on equity. However, remember, I told you that it's a risky proposition. Imagine now that your net income turns to negative. Okay? Instead of being 10, suddenly it's minus 10. Let me see if I have any color options. I don't think so. Yeah, let's not waste time. Okay, so suddenly, maybe next quarter or next year, your net income becomes negative. Well, your ROA will be minus 10%. And for term B, so again, it's minus 10 here, it will also turn to minus 10%. But now look what happens with ROE. For firm A, it would still be minus 10%. But for firm B, it's going to be dramatically bigger in absolute term, minus 20%. So as you can see, when you're doing well, if your ROA is positive, when your net income is positive, having leverage is a good thing because you go from 10% to 20%, okay? Your ROE is boosted by factor of 2. But when things are not going well, all right, when you generate negative result, when your income is negative, when your ROA is negative, then you are exacerbating the problems. So what you're doing, instead of sort of boosting your performance, you're exacerbating your loss. You're going from minus 10% to minus 20%. Okay? So that's where leverage becomes very, very tricky. So graphically, you could look at it this way. So if this is, let's say, your time or state of the economy, and this is your ROA and ROE, okay? So you have, let's say, 10% here, and let's say, actually, let me raise it up a little bit. So here's your 10%, here's your minus 10, okay? So for firm A, let's say you have two states of the economy. This would be your ROE and ROA, okay? In good times, ROA is 10. In bad times, ROA is minus 10, okay? You don't have to connect them like this. You could just draw some bars, okay? So you could do it this way maybe. Okay? However, if you look at firm B, the picture is very different. So that's your time T, that's your ROA and ROE. Okay, so here's your 10% minus 10, and here's your 20, and minus 20. So 10% minus 10, 20 minus 20. So as you can see, your ROA is 10, your ROA is 20. I'm gonna write it maybe a little bit closer like this. When your ROE is minus 10, excuse me, ROA is minus 10, your ROE is minus 20. So if you draw the bars, you'll have something like this. So as you can see, your ROE is much more volatile than your ROA. And that's what the leverage does, okay? When there is no leverage, when equity is 100%, your ROA and ROE are equally volatile. There is no more magnified volatility. They go up and down, okay, but they go up and down by the same amount. However, when you have leverage, your ROE could be much more volatile. Now, how much more volatile? Well, that would depend on that equity multiplier. That's why we call it EM. It's called equity multiplier. Remember, I told you I will give you that definition. So remember again, your ROE is equal to ROA times EM, equity multiplier. Now, I can give you the meaning of equity multiplier. If I take derivative, okay, so I'm gonna do delta ROE with respect to delta ROA, okay, which is approximated by d ROE times d ROA. So that d is just calculus notation. Remember, derivative is just the change in your y variable divided by change in your x variable, but for very tiny small changes. So usually we approximate any delta with derivative. So if you hold ROA constant, okay, so assuming that ROA is constant, assuming that equity multiplier is constant, I'm sorry, then any change in ROA will result in EM changes in ROE. Okay, so the derivative of ROE with respect to ROA is equal to EM. Okay, so let's just verify that's the case. So what is equity multiplier for firm A? Equity multiplier that is equal to 1 plus debt over equity is equal to 1. Why? Because debt over equity is equal to 0. There is no debt, so debt divided by equity equal to 0, so equity multiplier is equal to 1. However, for firm B, EM is equal to 1 plus, and then 50 over 50, that's 1, equals to 2. Okay, so how do we interpret it now then? Well, for 1 point change in ROA, okay, you're going to have EM point changes in ROE. Okay, so interpretation again of equity multiplier for 1 percentage point, because remember, ROE and ROA are measured in percent, so we are changing by 1 percentage point. So for 1 percentage point change in ROA, we will have EM percentage points change in ROE. Okay, so what does it mean? It means that for firm A, if ROA goes up by 1 percentage point, ROE will go up by 1 percentage point. Similarly, if ROA goes down by 1 percentage point, ROE will go down by 1 percentage point. So there is no magnification, there is no leverage. On the other hand, for firm B, if ROA goes up by 1 percentage point, ROE will go up by 2 percentage points. And that's where the leverage becomes at play. Okay, so yes, when ROA is here, ROE is double. But when ROA is down, the ROE is double down. Okay, so again, it could be a double-edged sword. On the one hand, it helps you, it boosts your earnings when things are going well. But on the other hand, it really hurts you if things are not going well. So you got to be very careful with this notion of leverage. It might seem like leverage is a good idea, and it is sometimes a good idea when it's not used excessively, if you don't push it too far. And also leverage is usually more likely to happen when things are going well. So you could claim that leverage is a pro-cyclical phenomenon. When the economy is doing well, companies are usually increasing their leverage because they understand that the sales are going to grow, the incomes are going to grow. Why would you share all that extra profit with more shareholders? You don't want that. You want to keep your shareholder base lower, but instead you finance your growth with more debt, because debt requires just fixed interest payment and all the extra profits go to the shareholders. On the other hand, when things start slowing down, when economies are not doing well, and companies and businesses expect deterioration of economic conditions, the slowdown in sales and earnings, they might deleverage. So what they are doing, they're now playing safer. They realize that the bad times are coming, so maybe it's better to have more equity and less debt, so that they kind of spread the pain among more shareholders. Okay, so that's the idea of DuPont identity. Now, what we can also do is combine these two factorizations. So again, just to remind you, ROA is equal to profit margin times asset turnover, and ROE is equal to ROA times equity multiplier. So now if I combine them, I could say that ROE is equal to, and I'm going to put this right in here, it's equal to profit margin times asset turnover and then times equity multiplier. Or alternatively, even better way to look at it, profit margin times asset turnover times 1 plus debt over equity. So that's the best way to visualize your ROE. So now you can see that ROE is driven by profit margin, which is cost efficiency, asset turnover, which is your ability to efficiently generate sales with your assets, and the degree of financial leverage, which is debt over equity. Okay, so that's basically what this equation does. It's just exactly what I wrote. So your ROE is profit margin driven, usually a firm operating efficiency, how well the costs are controlled. The asset turnover efficiency, which is driven by inventory turnover, accounts receivable turnover, and fixed asset turnover. And finally, your equity multiplier, which is just a measure of the firm's overall financial leverage. So here's a DuPont identity for our company. So we already know all the ingredients. We know ROE, we know ROA, we know profit margin, asset turnover, equity multiplier. So basically, your ROE is driven by relatively high profit margin, kind of slow asset turnover, and then, some leverage. So as long as your equity multiplier is greater than 1, you do have leverage. Okay, only if it's equal to 1, it means you have absolutely no leverage, you're 100% equity financed. So again, is it normal? Is it not normal to have those type of factors, those values? It's not clear. It depends on industry. Again, for some industries, profit margins are low, but asset turnovers are high. For other industries, it's the other way around. For some industries, a lot of debt is normal, like in banking. Like I mentioned before, banks have huge leverage. For other industries, like manufacturing, heavy machinery, retailing. Too much leverage is not normal. So it's hard to say what is normal. You always need to benchmark. You always need to compare to industry standards. So here's an example. We have Walmart versus May department stores. These data, of course, are not current. This is just example from your textbook. But you could always repeat it with actual data. You just need to download financial statements and recalculate those ratios. But the point is, it's just an example. So let's say we have Walmart, we have May department stores. I'm not even sure if May department stores exist as a firm. I think it might. But you could do it Walmart versus Target or Walmart versus Macy's. It doesn't really matter. So let's say you observe that Walmart has higher ROE compared to May department stores. Okay? Well, you jump to conclusion that Walmart is doing better. True. But now let's say you want to know. You want to factorize it. You want to know why is it happening. What are the driving forces behind good performance of Walmart in terms of return on equity? Well, you start with profit margin and you observe that profit margin is not the reason why Walmart is doing better. Because actually profit margin of Walmart is lower than May department stores. But it turns out that Walmart more than compensates for it by much faster asset turnover. As you can see, Walmart's asset turnover is almost twice as large as that of May department stores. And that's not surprising. That's their business model. Their margins are lower. Okay, they try to give their customers the best possible price. They also have relatively low cost because they negotiate the buy in huge amounts, so they're able to reduce their cost. So that helps their profit margin a little bit, but still their pricing is way, way lower than everybody else's. So what's going to happen, their profit margin on average is going to be lower than some of the more high-end stores, but they're able to generate a lot of sales with their assets. They're extremely efficient. They're extremely efficient in managing their inventories. They're utilizing their capacity extremely well. They probably have very little accounts receivable because they don't sell anything for credit, or very little. And as a result, their asset turnover is really fast. But then it turns out that they also use more leverage. As you can see, their debt to equity ratio is actually higher. Not much higher, but higher. Roughly 20% higher than that of May department stores. Most likely in this example, it could be explained by cheaper access to funds. Walmart is a very large company, very well known, with excellent credit rating and all the parameters by which potential lenders evaluate the firm indicate that Walmart is just rock solid. So what's going to happen, perhaps for Walmart, it will be cheaper to borrow. The interest rate might be lower. As a result, they use that, they utilize their opportunity to access cheaper sources of funds, and they maintain higher debt to equity ratio. So all of those factors together result in higher ROE. So again, as you can see, even though Walmart is lagging in terms of profit margin, it compensates for it by being more efficient in terms of its asset turnover and being more aggressive in terms of its debt utilization. All right, finally, I would like to mention that the statement analysis, financial statement analysis, all of the stuff that we are doing need to be done in a context. You should never just look at the ratio in isolation at a particular point in time for only one company. It's not going to be meaningful. Okay? So for example, let's say, here is a let's say here is my time t, and that's my ROA. Okay, so here's my point t. I'm gonna call it T1, and this is, let's say, ROA t. Okay. And let's say that ROAT is equal to, I don't know, 8%. What does it tell me? Nothing, okay? So, and by the way, let me call it A, meaning that it's company A. So ROA for company A is equal to 8% at point T1. Is it a lot? Is it a little? You don't know. You should never just make any conclusion by simply looking at one point in time for one company. So the first thing you need to do is, at least you need to do time trend analysis, okay? So you want to make sure that you compare and you look how company was doing over time. You want to know what the trend is. Is company trending up? Is company trending down? Okay, so 8% might be a good sign if it used to be 6, 5, 4, and so on. Like Tesla, for example, right now, they have minimal earnings, very low earnings, but markets are ecstatic about it. Why? Because in the past, Tesla was losing money, and now they finally turned profitable. So for Tesla, it's a very good sign. On the other hand, if you look at company like Amazon or Walmart, and you simply look at their profit and it's positive, it doesn't mean much. You want to know how it is compared to past, right? You want to look at the trend. So at the very least, you want to see maybe something like this. Okay, and then you could extrapolate. So let's say that's what you saw in the past. Okay, now your information is a lot more meaningful. So you know that even though now it's 8%, it's not clear yet if it's good or bad, but you know that the company is on the rise. That's a very good sign. The second part that you always need to do is to look at peer group. You always do peer group analysis. So you compare to similar companies within the same industry. That's extremely important because again, 8% for GM is not the same as 8% for Bank of America. It's not the same for 8% for Apple. Completely different companies in completely different industries. So you always need to do peer group analysis. So how can you do it? Well, if company is well known and well studied, if you know that firm really well, let's say you're Samsung, you should know the competitors, perhaps LG, maybe a few other companies, maybe Apple. So, well, you just identify competitors from your knowledge. If company is smaller and less well known, you might want to get help from some commercial databases. So what those commercial databases do, they basically have SIC, Standard Industry Classification, or NAICS, it's a replacement for SIC. It doesn't really matter what abbreviation says, but think of it as industry classification. All right, IC, that's the key here, industry classification code. So what it does, it basically assigns a particular code to the industry in which company operates. The beautiful part about it is that without knowing the nature of business of the firm, you could still analyze it and compare to the peer group by identifying all the companies that have the same industry classification. Okay, so that's huge help. So if I'm analyzing some, I don't know, semiconductor manufacturer, medium-sized semiconductor manufacturer on Long Island, I mean, I don't know that industry really well. I don't know who the competitors are. So what I do, I go to commercial databases like CompuStat, okay, and I write a code. I say, give me all companies that have SIC code equal to, let's say, 4,300, something like that, okay? Because that particular SIC code, let's say, corresponds to semiconductor industry. And immediately you get, let's say, 500, 200 companies. Then you could sort them out by location, for example. Let's say the company is relatively local, so you want to make sure that you compare only to Long Island firms, or maybe only to New York firms, or only to US firms. It depends on what your market is. So the bottom line, no matter how you do it, you want to make sure that you compare to the peer group, whether it's just hand-picked competitors or more comprehensive analysis done using some commercial databases. So for instance, on our chart. So looks like the company is on the rise. Okay, so let's say here is your peer. All right, peer groups. So that would be your firm A. Here is your peer group. Okay, now looks like it's bad news because peer group actually on average has higher ROA. So even though the company is on the rise, still the peer group is outperforming the company. So the next step would be to also do trend analysis for peer group. Okay, and maybe you see something like this. And now the picture looks not so good for firm A because first of all, its ROA is actually lower than industry standard, but probably more alarming is that the gap between the industry and the firm is widening. Okay, a few years ago the gap was relatively small. Now the gap is pretty large, meaning that they're both trending up, but the industry is just growing faster in terms of its return on assets. So that kind of analysis you need to complete for sure every time you compare, every time you analyze the firm. So you should never do it on individual firm only and only at one point in time. The last thing I want to talk about in this part before we switch to financial planning is that there are some complications when you conduct financial analysis like this. So number one is there is no underlying theory that would tell you which ratio is more important or most relevant. But that's not a big problem. It just means that you have to be careful with interpretation. You should not be favoring one ratios over the other. Okay? So for instance, what's more important, profitability or liquidity? It's not clear. You could be more profitable, but if your liquidity is terrible, you may just run into liquidity issues and you will not be able to pay back your short-term obligations. That would result eventually in some unexpected fire sales of your assets, which is not good. Similarly, what is more important? Let's say debt utilization ratios or asset turnover ratios. Well, asset turnover ratios show you efficiency. They're important for your profitability, but debt utilization ratios show how much debt you have, which is a different area of concern. But no matter how good you are in terms of asset efficiency, if you borrow too much, if you have huge debt to equity ratio, you're running huge risk. So the point is, you should never compare companies across different ratios and say company A is better because it has better liquidity and I like liquidity more than profitability, or the other way around. You should not be making statements like that. Instead, you should just simply analyze each area, each ratio, give your recommendations about how to improve those ratios, and that's it. You should not be favoring one group over the other. The second is benchmarking. Now that is a real problem. We are talking about benchmarking for diversified firms, for very large diversified conglomerates. So let me ask you this question, hypothetically. Who is the competitor of General Electric? I mean, it's impossible to figure out who is really their competitor. The reason for it is because GE, General Electric, operates in so many different industries. GE makes everything from light bulbs to appliances to engines for airplanes. It's vastly diversified conglomerate. The same can be said about, let's say, Samsung, Korean company. So Samsung produces, refrigerators, but it also produces cell phones and computers, laptops. Okay, and they also deal with real estate and they have financial arms and so on and so forth. So Samsung is extremely large diversified conglomerate. So again, if you ask me who is competitor of Samsung, a lot of people would say Apple. Well, true, but only for certain part of Samsung business. Apple has nothing to do with appliances, and Samsung produces a lot of those washing machines, Samsung produces TVs that Apple doesn't, up until recently at least, and so on and so forth. So you can't really compare Apple to Samsung. If you look at consolidated financial statements, the comparison between Apple and Samsung is going to be invalid. So what you need to do really, you need to figure out how to do benchmarking for those diversified firms. And it's extremely difficult. The only way to do it is if you have access to very detailed data for the firm, if you are inside the company, not an outside analyst, but insider, then you should be able to deconsolidate that balance sheet and income statement by industry, by segment. So for example, if you're analyzing Samsung, you could figure out its revenue, its cost, its assets, its liabilities associated with mobile devices, for example. It could be done, but only if you work for that firm. And then you compare it to Apple. But you should never compare consolidated balance sheet or consolidated income statement between those two companies. Luckily, most firms are not like Samsung, they're not like GE. Most firms are more focused. They're more like Apple or General Motors or Boeing. They operate in relatively narrow industry, so it's a little bit easier to identify competitors. But if you do get, into a situation where you need to worry about benchmarking, the way to do it is to deconsolidate, decompose the financial statements into segments. The third one is globalization and international competition that make comparison more difficult because of differences in accounting regulations. Well, basically what happens is not all companies have generally accepted accounting principles. Not all of them adopt GAAP. In some countries, it's a different system. I know that in Korea, for example, the system is different as far as I know. That gives some room for companies to report in a different way, and as a result, whatever is considered inventory in one country may not be counted the same way in another country. So the accounting procedures might be just simply different, the accounting regulations. That makes it difficult. The fourth one is that the firms use varying accounting procedures even within their regulatory environment. So let's say you compare two GAAP firms, generally accepted accounting principles in US. So you have, let's say, Ford and General Motors, same industry, same regulatory environment, but still their accounting procedures might vary because the same system might allow for some flexibility. One example would be the inventory account, first in, first out, versus, let's say, first in, last out, or last in, first out. So depending on how you count your inventories, you might have different results. Also, there is a notion of so-called accounting conservatism, how you recognize losses versus gains. Some companies are very conservative, they recognize losses immediately, but they have much more stringent procedure for verification of gains. That is called high degree of conditional accounting conservatism. So you could think of it as companies wanting to have bad news coming out quickly, but good news they want to double check. So they don't want to lie about good stuff, but they want to be extremely transparent and very quick about bad stuff. Some companies may be less conservative. They might, recognize gains very quickly, but as for losses, they might drag their feet and try to slow down the process so that the bad information doesn't leak very quickly. So that's just two completely different approaches to accounting that might result in very different reporting of their earnings. Then you have differences in fiscal years, and that is also true. Some companies report their final annual statements in December. Some companies might do it in June. And due to seasonality, the differences might be pretty dramatic. And finally, some extraordinary or one-time events may really mess up your calculation at one particular point in time. But that's not a problem because if you do time trend analysis, you will realize that perhaps certain observation is an outlier. So for instance, if this is my time and this is my ROA. So let's say you have some extremely poor performance here, negative ROA, but if you do trend analysis, you will see that company was something like this, and then boom, it went down. Well, most likely it's some kind of extraordinary one-time event. You need to see what happens. Maybe it was a coronavirus pandemic. Maybe it was some lawsuit that the firm had. So doing trend analysis and also comparing to the industry peer group always helps.